You want to do your pulled pork now, seeing as we're getting up to an hour and we haven't even got to there yet? Over an hour. Oh my God.
Yeah,
sorry.
That's all right. I'll try and be as quick as I can. Aurizon Holdings. And I've done Aurizon before, but it was quite a few years ago. It's back on the bottom of our buy list. Its QAV score is 0.1, so it's the very last stock. And I've included it today, A, because it's new on the buy list, but B, because it's a large ADT stock, so it will suit large shareholders. I've owned the stock in the past, I don't own it now. It comes out of a government float back in 2010 of a company called Kynaston, which, as you'd expect, is a rail haulage company in Queensland. And it was listed originally as Kynaston and then changed its name to Aurizon Holdings. The market has got a hold of it. Its basic business is hauling coal from the Queensland mines to terminals on the coast. So if you don't like that, if you're ESG oriented and don't like a coal haulage company, then look away now. They do make a bit of a play with the statement that hauling things around Australia using rail is the best or the lowest emitter of carbon than compared to road or air. So they do make some claim to be less carbon intensive, but anyway, you can make your own decision on that. It's started off life owning the rail tracks, which I think it now leases from the Queensland government. It also allows competitors onto the rail network, but it's also diversified away a lot from hauling coal from the Bowen Basin to the Queensland coast and loading it on ships. It now does a lot of iron ore haulage, it does a lot of grain haulage. It runs the rail networks between Darwin and almost all the way to Adelaide, so in the outback and as well over in WA. So it's diversified away a lot from coal. But it still does a lot of coal haulage. What else can I say about it? That's probably all I want to say about it in that sense. It was listed, the listing was fairly contentious, I remember, because I was investing around the time when it was listed. The sort of thematic was that this was a government-owned business, and government-owned businesses, when they were taken out of government ownership into private hands, had a profit bump because private ownership could do more with the cost base, more with efficiency, was less beholden to unions, that kind of thing. And certainly that had been the case with some of the listings before that, most notably CSL. But over the years, even though the stock price went up, it's now back around where it was when it listed some 15 years before. So it listed at $2.55. Price today is, I'll have a quick look, it was around $3 something, $3.10 I think, when I did the analysis. No, $3.53, so it's actually climbing, but it did get back around to its listing price back in May of this year. They reported bad numbers in their latest results, so they reported a 25% fall in net profit after tax. And they claimed that the group earnings were pressured by weaker bulk haulage, containerised freight losses, impairments due to companies not being able to pay them, and higher restructuring and legal costs. So they also provided guidance at the lower end of growth, so a subdued earnings outlook. Dividend performance was also below market expectations. Final dividend of 6.5 cents fell short of the 6.9 cents expected, and this company is driven by its dividend yield, so that wasn't good. But interestingly enough, the market digested that, and now the share price is going up again, possibly because of the action that's been taken. So Aurizon announced 250 job cuts this year in answer to its profit decline, and they also increased their share buyback program. And the other thing that's kind of keeping the market interested is that they are thinking about what to do with the Queensland rail network. And the AFR back in August 18 reported that Aurizon Chief Executive Andrew Harding said, "No decision has been made on whether to sell or keep the company's Queensland rail network, which earns steady income from operating and maintaining rail tracks. but the CEO confirmed Aurizon had been asking potential buyers to put a value on its network. And there's been a few articles around like that, one from the week before. Aurizon in discussions to sell $4 billion stake in Queensland Rail. Aurizon is in talks to sell up to 49% of its Queensland rail tracks, a key piece of infrastructure for the export of coal, seeking bids of up to $4 billion to arrest sliding profits and restore investor confidence. The country's largest rail freight business and its advisors have invited private infrastructure investors, hedge funds and insurers to take a highly confidential look at the 2,670-kilometre Central Queensland coal network. A sale of a minority stake in the network or spinning it off via the merger would be the biggest shake-up at Aurizon since it was privatised back in 2010, etc., etc. So there's a little bit of work going on there. So perhaps that's coming down to the sharp end. There's a few other articles about that too. And maybe the market's getting excited about the spin-off of that coal haulage business and network. But the other thing it may be getting excited about was on the front page of today's AFR. And there's a story announcing that Macquarie Group's infrastructure arm is launching a takeover for Cube Logistics, QUBE, which is partially a competitor, certainly in the infrastructure space for logistics. And I'm drawing a long bow here and saying that could lead to consolidation in the industry. May or may not, but certainly was a bit of an eye-opener, I think, in this space. I would classify this company as a bond proxy. We've talked about them before. They're kind of companies like, say, Dalrymple Bay, which is possibly where Aurizon takes its coal to. So that's Dalrymple Bay is the terminal which loads the coal ships and has a steady income stream of contracted work and then pays a high dividend based on its margin for doing that contracted work. So it's a bond proxy. So in other words, it's you give me your money as an investor for a while, I'll give you a dividend coupon, and the business will still be around in 10 years' time to pay you back. So I would have thought AZJ would make a good fit with a large super fund, or for a large super fund, and the large super funds have been busy hoovering up infrastructure type assets and then taking them off market to put into their own super funds as unlisted assets. And the likes of Sydney Airport come to mind and certain toll roads. So I wondered why Aurizon wasn't in that camp, given that it's part of its business anyway is regulated, it's monopolistic, and a defensive infrastructure business. But I think one of the reasons why it hasn't been picked up by a super fund is because of the ESG concerns with the coal exposure. So something like 70+% of Aurizon's EBITDA is still coal related, which is the network business and the haulage business. And even though those volumes are contracted and stable, the market applies a permanent ESG discount and assumes a long-term volume decline. Another thing which is made super funds a bit wary about buying a stock like Aurizon is that at the moment it's not going through a period of high capital investment, but it has in the past, and there's been a need to upgrade its network, its rail network, its rolling stock or its trucks, so it's trailers on the behind the engines, and what they call corridor maintenance, so the land around the railway. So it does have a high capex usage, which is not necessarily appealing to investors. And I think the last sort of reason for it is that it's no obvious growth story. So it's a mature business, which is not a bad thing because, like I said, super funds will take on those low growth businesses if they either can combine them with other low growth businesses. So oftentimes, if they buy one airport, they buy other regional airports as well and try and look for some synergies through management or combining them together there. But they haven't had a bite at Aurizon. But perhaps if there's consolidation in the industry, that may change and that might get some interest because the share price has been going up this second half of the year and based on bad results, so something's up. I guess in summary, it's not a broken business. It's not expensive. It's going to be around for a long time. It still has some monopoly-like characteristics. But I think it probably needs a catalyst before it sees a real upturn in share price, more than it is now anyway. Some of the analysis I read said that The non-coal bulk haulage rates had to probably double in scale to make it attractive and to offset coal. Coal has had a bit of a volatile outlook in terms of its shipments, and so some kind of stability has to come to the coal market to make this company more attractive. And I guess, once one takeover bid appears, I think it might garner some interest in this company. So that's what's going on with the business. If I can look at the numbers now, so it's a large ADT stock, 14.3 million. Stock price for my analysis was $3.51, which is greater than IV1 of $1.06 and IV2 of $2.42, and actually greater than consensus target of 5%. So we don't often see that, but it is in this case. Can't buy it for book or book plus 30, which is $3.03, so it's trading above that. Yield is nearly 4.5%, which is not bad, but we don't score it because it's not bigger than the mortgage rate. Stock Doctor Financial Health and Trend is strong and steady. Stockopedia quality rank is 80, which isn't too bad. And the F score is 7 out of 9, which is good. The overall Stockopedia stock rank was 82, and it falls down on momentum, which only ranks 53, because as I said, until the last couple of months, the share price has been going down. The PE is nearly 17 times, but it's not the highest or the lowest, so we don't score it for that. PropCAF is good. It's trading at 4.21 times. So that's the attractive part of this business, is it's throwing off lots of cash, notwithstanding the fact that from time to time it does have to invest back in itself as well from a capex point of view. Earnings per share forecast growth is 16% and potentially questionable by some of the analysts I read about looking at this company. But even so, even if it does do 16% earnings per share forecast, it doesn't score on our growth over PE anyway. Growth over PE is only 0.97. It doesn't have an owner-founder, and directors have very negligible ownership in this company. And that was another interesting tidbit, I thought, is the company's been run for about 10 years by an I think it was Rio Tinto senior manager, who I guess might be ruining the fact they left Rio Tinto. But I wonder when 10 years or how long is enough for this person, and whether they may countenance a rollout or a spin-off of the rail network or part of the rail network to try and get the share price moving again. Certainly the right time to do it. I mean, you can't spin off that network when the share price is high. It doesn't make any sense. But when the share price is low, you can get an attractive bid, which makes it more achievable. How can I summarise this company? I should sum it up first of all. The total quality score is 7 out of 16 or 44%, and the QAV score is 0.1. The company lacks quality. We're giving it 44%. Stockopedia was a bit more generous, but it's certainly made up for by stronger cash flow, so it gets onto our buy list on that side of things. Plenty of risks and opportunities for the company. Obviously, the coal side of the business, whilst being volatile, is an ESG markdown on its valuation. It's recently had a lot of disruptions to its haulage business, either because of floods or cyclones or industrial action, and there have been some derailments which have shut down their network for a while. So it's a little bit volatile from that point of view. As I said before, there is capex drawdowns from time to time, and there's also regulatory risk, not just around ESG, but also perhaps on the pricing that they have to get agreed by the government for the Queensland coal haulage. On the positive sides, if they do spin off some of the rail line assets, that may lead to a re-rating of the rest of the company and its valuation. And it also gives them a potential use of funds to go after consolidating in the haulage space as well themselves. But at the low end of their share price graph, they're, I think, potentially a takeover target. And if they do somehow split the coal business, I think it makes them even more attractive. So that's what is probably occupying the board's minds at the moment. So that's AZJ, Aurizon Holdings.
Any explanation why they're called Aurizon AU? Is it Australian Horizons? Is that what it's?
I think so.
Play on?
I mean, it was, yeah. Like I said, I remember it being a fairly contentious listing. There was a lot of conjecture that the Queensland government had a fairly efficient rail network going on, so the valuation that was floated at was too high, and then about a year or two later, the market has got a hold to rebrand it. So it's always had a kind of spin side to the valuation on this company.
Mm-hmm.
And it did go up in price, but now it's back down to a little bit above where it floated.
All right. Thank you, Tony. Aurizon. I'll email their CEO and let him know. After hours.